I'm Akin, Managing Editor with REIT.com, and we're here at the New York Hilton for REITWeek 2012, NAREIT's Investor Forum. Joining me is Thomas Akin, Chairman and CEO of Dynex Capital. Tom, lots of economic uncertainty out there. Does this create any opportunities for your company?
Absolutely. Dynex and our whole business in general thrives on basically the uncertainty in the marketplace. And this is driven through the fact that the Federal Reserve is going to have to keep rates exceedingly low for an extended period of time, which they've been saying over and over again for the last really 4 years now. And since we basically fund a lot of our investments through the Federal Reserve funding mechanism, this continues our source of capital at rates or extraordinary low rates, and it drives our dividend yield.
And so far in 2012, mortgage REITs have actually had a pretty strong year. What do you attribute that to?
Again, it's the uncertainty in the marketplace. You had the issues in Greece, you have now the issues in Spain, and in basically the response by all the central banks globally has been to lower interest rates, to basically stimulate their economies through either asset purchases or just overall lower interest rates. That continues to give us a funding source of extraordinary low levels. And the expectation, even if the United States, let's say, falls into a double-dip recession or has a contagion, as the word is used, that would basically inure to our benefit as we see those rates extend even further. I was just listening to Bob Evans on Bloomberg just before I walked in this room, and he was talking about accommodation beyond 14 now, and that would be extraordinarily good for our business model over the long term.
And Tom, right now Dynex has a dividend yield of 12%. How are you going to continue to drive that and sustain that for the next year?
Well, Alan, it's been one of the real attributes of the mortgage REIT business model is the fact that we can buy assets at reasonable levels due to the simple fact that the credit crisis has created an uncertainty in the marketplace, which allowed us to buy assets at reasonable yields and then fund them at a very low cost through the Fed funds rate, as I mentioned previously. We have basically started our portfolio post the credit crisis, and therefore we have in our portfolio a large amount of our cash flow that is for the most part government guaranteed or AAA high quality capital that we expect to continue to pay for the next 4 to 5 years. And so our dividend not only should continue to be at 12%, but we have not cut our dividend, and we've only grown our dividend every year since 2008.
All right, Tom, thank you very much for your time.
Thank you, Alan.
And for more on this and other REIT news and analysis, check out REIT.com.